Russia's invasion of Ukraine and the unprecedented sanctions and private sector decoupling are unleashing forces that slow growth and exacerbate price pressures. As a result, the geopolitical crisis has become a key force shaping the economic climate. Commodity prices, energy, metals, and foodstuff have skyrocketed. The public health crisis in Europe, the US, and Canada is easing, but parts of Asia are still in a highly contagious vortex. The shuttering of economically large parts of China is weighing on growth and threatening to disrupt supply chains. US and European equity indices sold off for the first 2 months of the year but stabilized and rebounded last month. However, the MSCI Asia Pacific fell for the third consecutive month. Official comments from China seemed to signal a significant policy shift and spurred some buying, but the CSI 300 still fell nearly 8% in March. Helped by a weaker yen, which bolsters the value of foreign income, not only profits, but coupons, dividends, royalties, profits, and licensing fees, more than exports per se, helped lift the Nikkei by almost 5% to lead the G7 equity markets. Equities performed well in the face of the sharp jump in yields. The 10-year Treasury yield rose 50 BP in March, the most in 6 years, to finish slightly below 2.35%. European benchmark yields mainly were 30 to 40 BP higher. The dollar value of the negative-yielding bonds in the world, Japan and Europe, fell below $3.0 trillion, the least in 6 years. It stood at $11.3 trillion at the end of last year. Germany's 2-year yield briefly rose above zero for the first time since 2014 but finished March with a negative yield of a little more than 7 basis points. Even at this late date, one still has to pay Portugal, among others, for lending to it for 2 years. Interest rates have not only surged, but the yield curves, 10 to 2-year, have flattened further in the US and Canada. In the US, the curve finished last year near 80 BP. It halved in January and February and briefly inverted in late March. Other parts of the coupon curve are inverted. The 2-10-year Canadian curve peaked in early January near 65 BP and is less than 15 BP at the end of Q1 22. The UK curve fell below 5 basis points in mid-February. Since then, however, it steepened back to more than 30 BP, slightly above where it finished last year. It ended March near 25 BP. New Zealand's curve, to round out the G10 that have hiked rates with deep bond markets, excludes Norway, was wandering between 40 to 50 BP most of the month before breaking down at the end of the month to 33 BP. It was near 45 BP at the end of 2021. Crude oil WTI was trading around $90 a barrel before the Russian invasion and jumped to nearly $126.50 before easing. However, using the 20-day moving average to smooth out some noise rose by 18.5% in March, 15%, or about $17 a barrel. The Federal Reserve Chair offered a rule of thumb in recent testimony. A $10 increase in oil price boosts inflation by about 0.2% and cuts growth by 0.1%. Europe is more exposed. The 20-day moving average of the natural gas benchmark has risen by nearly 60% since the war began. And the 20-day average price of natural gas in Europe had already increased by more than 40% since the end of last year. At the end of March, the Biden administration announced that it would sell around 1 million barrels of oil a day from its strategic petroleum reserve for the next 6 months. This more than replaces the amount of Russian oil the U.S. has been buying. The earlier coordinated release amounted to 60 million barrels, with the U.S. providing half. A more ambitious effort is needed. In early April, other large oil consumer nations may join. At the same time, the COVID-related lockdowns in China and higher prices may reduce some demand. Fiscal policy may not be as restrictive as previously indicated, and perhaps, an important partial offset to the tightening impulses from rates and energy. In Europe, some COVID-related stimulus will be replaced by energy subsidies, the investment necessary to decouple from Russia, and military expenditures. Japan's Prime Minister Kishida seems increasingly likely to propose a supplemental budget before the July election after the COVID restrictions and earthquake disrupted economic activity. Australia's Liberal/National proposed budget includes a 6-month cut in the fuel excise tax, support for first-time home buyers, and an increase in road and rail spending. Many U.S. states are considering cutting the gasoline tax, and federal action is possible. It might make for good politics, but it is poor economic and environmental policy. Also, in the U.S., the federal gasoline tax finances the highway fund, which seems a bit like eating one's own corn seed. At the end of March, the Biden administration announced a 180 million barrel drawdown of its strategic petroleum reserves over the next 6 months, or roughly 1 million barrels a day. It hopes that other countries make similar moves. Monetary policy is in flux. The risk is that with price pressures elevated and rising, the US, UK, Canada, and New Zealand may accelerate the pace of rate hikes. As a result, the odds have shifted in favor of 50 BP moves. The swaps market leans to a 50 BP hike by the RBNZ on April 12, followed by a similar move by the Bank of Canada the following day. The Federal Reserve and the Bank of England meet next in May. A 50 BP move is well discounted, but the market is divided about the bow. After the 25 BP hike in March, the officials tempered expectations by saying that further tightening might be appropriate. After the February hike, it said higher rates were likely. Norway has also signaled a more aggressive tightening course. The swaps market has brought forward the first ECB move to July from October. However, this would still require ending the bond buying earlier or changing the sequencing, stop bond buying before hiking rates. The ECB could push back against such expectations at its April 14 meeting. The market also sees the Reserve Bank of Australia moving in June. Previously, the swaps market had priced in an August hike. Sweden's Riksbank acknowledged that it will hike rates earlier than previously indicated, 2024. The swaps market is pricing in a hike in September and November, though some banks see the April 28 meeting as possible. It will likely wind down its bond buying efforts sooner. The U.S. response to Russia's invasion of Ukraine has boosted confidence in American leadership in most NATO countries despite the handling of the withdrawal from Afghanistan, according to a Gallup survey. In 20 of the 27 members survey, Gallup reported a double-digit increase in the U.S. Lithuania was the country that showed a decline in approval, to 22% from 28%. On the other hand, President Biden's domestic approval rating fell to its lowest level yet in the latest survey, March 21 to 22, by Reuters/Ipsos. Predictit.org continue to show that the Republican Party is easily favored to capture the House of Representatives and Senate in the midterm elections in November. There are 2 European elections in April that garner widespread interest. First, Hungary goes to the poll on April 3. Prime Minister Orban and the Fidesz party seek a 4th term. Although the opposition parties have united behind a single candidate, and Orban is more supportive of Russia than the general public, Fidesz is running ahead in the polls. A week later, on April 10, France will hold its presidential election. It is doubtful that any candidate will secure an outright majority. This will result in a runoff on April 24, where Macron is expected to face and defeat Le Pen again. Bannockburn's World Currency Index, a GDP-weighted basket of the top dozen economies, edged higher in March after falling in January and February. However, within the components, there was wide divergence. The Japanese yen was the weakest currency, falling by a little more than 5% and reaching levels not seen since 2015. At one point, it was down more than 7%. On the other side, the Russian ruble seemed to appreciate by around a third, though the trading remains distorted by the sanctions and capital controls. The Brazilian real appreciated by nearly 6% to bring the year-to-date advance to more than 17.5%. The Chinese yuan accounts for almost 22% of the index, and it eased by about 0.3%. The euro is slightly more than 19% of the index, and it was flat in March. Among the major currencies, the Australian dollar and Canadian dollar rose 2.1% and 1.4%, respectively, helped by the strong backing up of their rate, commodity exposure, and the greater appetite for risk reflected in rising equity prices. The MSCI All-Country World Equity Index rose almost 4% after falling by around 7.5% in January-February. Dollar. The preliminary indications suggest that although the U.S. economy struggled at the start of the year, it is proving fairly resilient in the face of the jump in energy and food prices and the surge in interest rates. There has been a significant shift in interest rate expectations, despite the criticism heaped at the Federal Reserve. The minutes from the March FOMC meeting, due April 6, are expected to have more color on the timing and pace of the balance sheet unwind. Many expect the balance sheet to begin shrinking as of next month. U.S. 2-year yield rose nearly 100 BP last month at its peak, the largest increase since May 1984. The 10-year jumped over 60 BP. While the 2-10-year yield curve did not remain inverted, yet, other parts of the coupon curve did, as many feared the Fed would not be able to achieve the proverbial soft landing or lower inflation without driving the economy into a recession. The Fed funds futures market has fully discounted more than 200 BP in rate increases this year, implying at least 2 meetings with 50 BP hikes. The market sees about a 75% chance of the first 50 BP hike at the next meeting that concludes on May 4. The swaps market puts the terminal Fed funds rate between 2.75%-3.0%. Euro. Spot, $1.1065, $1.1270. Median Bloomberg 1-month forecast $1.1045, $1.1300. 1-month forward $1.1075, $1.1280. 1-month implied vol 7.8%, 7%. March 31 indicative closing prices, previous in parentheses. There are 2 knocks on the euro. First is the war in Ukraine. From February 10, when the US warned that Russia was set to attack Ukraine, until a week after the war started, the euro fell by about 6% against the dollar. Europe is vulnerable to the disruption caused by the war and the subsequent sanctions. Stagflationary forces seem particularly strong. Second, the ECB will lag behind the Federal Reserve in adjusting policy. This is illustrated by the roughly 50 BP jump in the US premium over Germany on 2-year money, to around 245 BP. The ECB's new forward guidance suggests that asset purchases could stop in Q3, widely seen as a precondition for increasing policy rates. The hawks are pushing for an earlier end. This may be the focus of the April 14 ECB meeting. The swaps market is pricing about 50 BP in rate increases before the end of the year. The first round of the French presidential contest is on April 10. Macron is the easy favorite to be re-elected in the second round, April 24. Japanese yen. Spot, 121 Japanese yen and 65 sen, 115 Japanese yen and 55 sen. Median Bloomberg 1-month forecast 120 Japanese yen and 40 sen, 115 Japanese yen. 1-month forward 121 Japanese yen and 60 sen, 115 Japanese yen and 50 sen, 1-month implied vol 9.2%, 6.3%. The Japan 10-year government bond yield rose about 6 basis points last month, which prompted the central bank to defend its yield curve control policy cap. The USD/JPY briefly traded above 125 as this took place in part because it underscored the policy divergence with the US. Between the COVID restrictions and the earthquake in March, the Japanese economy may have contracted in Q1. The government's budget for FY22 includes more measures to address COVID, an increase in Social Security, and military expenditures. Nevertheless, a supplemental budget is in the works. It is expected to be around 10 trillion Japanese yen, $87 BLN, and the